I am very pleased to introduce an old friend of mine named Mike Krueger. Mike hails from Fargo, North Dakota. He, of course, is an editor or writer, if you will, with World Perspectives Incorporated. He has his firm called The Money Farm. I always wanted one of those, a money farm, and Mike's got one. So if you'd like one, I think you need to talk to him. But with that, I'd like to introduce him. Mike comes to us with a long experience in the grain industry. He started at Cargill, and he is well revered within the industry. And I look forward to his presentation, Is the Bull Really Dead? Mike, the floor is yours.
Thank you very much, Dan. All right.
There you go.
We'll go to this one. Thank you. Sorry for the brief delay. I want to echo the sentiments of those speakers who have preceded me. I'm glad to be back in Cape Town. I spoke at this conference 4 years ago. A lovely city, and I love the heat because it's not quite so warm where I come from. For those of you who have seen the movie Fargo, that seems to be our biggest claim to fame, although it wasn't filmed in Fargo. And now, if you'd like, there is a new television series that started last year that's been extremely successful, also called Fargo. I get the opportunity this morning to spend some time talking about what happened over the last several years, how this bull market was created, what's fostered it, and maybe where I think at least it could go. And of course, it all depends on world crop production. And looking at the program of speakers, some of whom you've already heard, and certainly those following me, including Dan, I think you're going to hear a lot of different opinions on where prices may go and why, and certainly provides everybody the opportunity to ask some good questions as we go on. As Dan said, I was assigned the topic, commodity markets. Is the bull really dead? And to start with, I thought maybe it would be beneficial to take a look at how we got to this bull market stage and see where prices have been going back to 1970. And as you can clearly see from 1970 up through 2000, 2008, with just a few exceptions, it certainly has been a buyer's market. Markets were flat, not a lot of price movement, easy to trade, easy to make money in the processing business or the livestock feeding industries or whatever. The bull markets that we did have were very, very brief. Certainly back in the early 1970s when the former Soviet Union, we all came to work one day, and that was just before I started with Cargill, and we thought Cargill had done just a little bit of business, and everyone in the stadium that morning at the Chicago Board of Trade had done a large sum of business, and that really is what propelled prices to kind of a new level from where we'd been prior to that. But still, we tended to just jag back and forth until we got to the mid-1990s, 96, the Mississippi River floods. This is corn, by the way, and I'll show you wheat in just a second. Very, very similar pattern. And I've used wheat and corn, a lot of different charts, because they do have some relationships. And then in the early 2000s, just kind of back to that flat pattern until we got to 2007, 2008 in terms of corn, when the U.S. biofuels mandate kicked in, and we went from using less than 5% of our corn crop before that to where today we're using between 35 to 40% of corn, and that was probably the single biggest factor that made these markets kind of erupt higher. That ethanol game took off much, much more quickly than anybody thought it would. So here we are with Chicago wheat, same pattern. The USSR buys, we have the Mississippi River floods, the biofuels mandate took off. But also during that time, right after the U.S. ethanol industry got booming, remember that we had the smallest U.S. and world wheat supplies basically ever. That's when I think there were some legitimate concerns for the first time that somebody might go without wheat. Those were the years that we took Chicago futures to $14, $15, $16, Kansas City to $20, Minneapolis to $24 a bushel. Back in the late 80s, there was one other little blip in these markets, and that was the big drought in the Midwest of the U.S. But even back then, that market started to rally in late spring, very, very early summer, but the rally was done by July and August. The market was had priced in the shortages, and we were back on our way to lower prices. These days, however, we are in the, depending on how you count it, 6th or 7th year of what's been the longest bull market in history. So why have we been in this strong bull market? Well, first of all, demand growth has accelerated. And I'll show you a little bit of that in the next couple of slides. Not only because of population growth in the world, but because, more significantly, the middle class continues to expand extremely rapidly. Because of that expansion of the middle class and more disposable income to go towards diets across a big chunk of the world have improved and changed. And I think it's important to understand that these diets have changed probably forever. 30, 35, 40 years ago, whenever I first started, we used to kind of watch wheat and rice prices, and if one or the other got out of line, world diets would change. We don't see that much of a change anymore. We don't see wheat consumption drop and rice consumption go up, for example, in Asia when we see price discrepancies. So there are those who suggest that this improvement, this change in diets, isn't going to change. It's going to stay with us regardless of prices. I talked about what happened with ethanol when we took 40% of the U.S. corn crop and now started to put it into gasoline. Biofuels began to take over excess vegetable oil. More so in the rest of the world than in the U.S. It's been a very, very slow process getting biodiesel on track in the U.S. In fact, just in the last couple of days, they finally approved retroactively the biodiesel credit for 2014. And we're in the last 5 weeks of the year or less. And certainly throughout the last 4, 5, 6 years, we have had some crop production problems around the world, which magnified the increase in demand. Other things have changed. Commodities became an investment class attracting huge amounts of money. Commodity funds became a new demand category. We talked 3, 4, 5 years ago that when we look at supply and demands for wheat or corn or soybeans or whatever, that maybe we needed to add that fund demand. We have a feed demand, we have an export demand, we have a crushing or processing demand, and maybe at times we needed to add another category, fund demand, because we saw huge increases in cash, and as we all know, and we've seen evidence of it in the last 20 or 30 days, big cash, maybe not related to our markets at all, can change markets pretty dramatically and pretty quickly. We saw futures markets adapt quickly to this new demand category of funds. Now electronic trade has replaced open outcry trade, and frankly we couldn't do the kind of volumes of trade or any place close to it that we're doing today through the open outcry and the pits. Trading hours have been greatly expanded. You know, for a while we were trading 21, 22 hours a day in Chicago. They've backed that off. But nonetheless, some of us still get up in the middle of the night. I'm sure Dan does at 3 or 4 whenever Europe comes to work, and just to see what's going to change at that time of the day. Daily trading limits greatly expanded, at least in the U.S. and in Chicago, and now we've gone to these variable trading limits. So big changes, and through all of this, we created extreme price volatility. Those of you who've been buyers or traders in this environment know all about volatility, and have certainly at least understand it a whole lot better because we never had that kind of volatility up until the last 5 or 6 years. The summary of the problem basically is that we're headed towards 9 billion people in the world. It's accelerating demand quickly, incomes are growing, urbanization, and certainly you can't talk any kind of a commodity these days without mentioning the word China. More so in the case of soybeans than wheat and corn, but I think eventually, looking ahead, their imports and consumption of wheat and corn will expand as well. Productivity, according to some people, ag productivity actually is a little bit less today than it was back in the 60s. That's kind of an interesting statistic, but true. Some areas of the world actually have seen declines in planted acres. And certainly we've seen a paradigm shift in commodity prices over the last 5, 6, 7, or 8 years. And the question a lot of people's minds is that a permanent shift? Have we elevated prices to kind of a new level, or can we go back to those levels that we've gotten used to for 30 or 40 or 50 years? This is a well-traveled chart developed by the USDA Global Policy and Analysis Division, part of their Office of Global Analysis. And the red line that I put here is back in that 2006, 7, 8 range, kind of the period where I think the bull market really started. And going forward on some of the other charts and graphs, you'll see I put that red bar there just to say that's basically where the bull market started. This is the growth in middle class outside of the U.S. Here we are today, basically at the end of 2014. So this change over this period of time, and when you look at going over the next 10 years, to me is one of the key things to keep in mind about whether this bull market is really dead or just taking a brief pause, and whether we'll see this whole thing resurrected again. People who suggest we're only halfway through this big bull market that we've seen basically are using this chart pattern, saying we're only halfway through where we think the world is going to be in 2021, 22, 23, in terms of the middle class becoming much, much larger, improving diets, and creating an increased demand, particularly for protein. These are the countries where that growth has been the most rapid, obviously, China clearly being the leader, and then go on down India, Russia, Brazil, Mexico, of course, Asia, Southeast Asia. Indonesia doesn't look very big on that chart, but a friend of mine in the business in Indonesia, in fact, he works for U.S. Wheat over there, said by some calculations, the middle class in Indonesia alone is growing by nearly 7 million people a year. So that's what has really accelerated these markets in terms of demand. Demand for protein has been soaring as these diets have improved, and although this is a chunk of red meat, certainly in a lot of the world, and particularly Asia and China, it's been the growth and the expansion in pork and poultry production and consumption that has driven the enormous demand that they have for protein to feed those increasing flocks and herds. We've talked, there's been stories in the U.S. recently about the return to the caveman diet, getting away from carbohydrates, going strictly to protein. And this is kind of a depiction of the caveman diet. And here, the very last person, I hate to trash our own population, but that's kind of my viewpoint of the U.S. caveman today. We've kind of gotten away from the lean and the mean type of an issue. International Monetary Fund, and this is their latest projections for the year 2016. Not the next year, but 2016, just to look out a little bit in terms of real gross domestic product growth. And of course, I tell our farmers in the U.S. that's the area we're concerned about for the most part. Secondly, of course, the Middle East and Africa. But this is where the early growth has been very, very strong, and where we anticipate that growth is going to continue. I tell them, don't worry so much about what goes on in Western Europe, in North America, in the developed markets. We don't frankly care about that from a U.S. producer's perspective, because we need to export a big chunk of our wheat, corn, and soybean production. So the important thing to us is, if we really believe and want to get bearish, if we think that these parts of the world, and of course, secondly, the region we're in today, if we think that those countries are going to drop off a cliff and an expansion decline, that certainly might be the most bearish element going forward in terms of agricultural commodity prices. I talked about the new demand for futures, the new demand category, funds, and I again wanted to point out what's happened. This is corn, open interest, total number of contracts traded, and again, the red line kind of marks the beginning of the bull market. Just to give you an idea, going back historically, open interest in corn would maybe be 600,000 contracts. All of a sudden, with the start of that bull market, we have quadrupled that volume, and we have sustained that kind of trading volume for the most part right on through where we are today, even though prices are certainly well off of their highs. Managed money, net positions, and again, part of the new demand category, and again, the case of total number of contracts, futures, and options. Anytime they're above that black line, it means that managed money was long, and below the line they were short, and certainly as prices have crashed in the last 6 to 12 months, they've dropped down to the short side, popped up again recently, and here's where we sit today, and that was as of about 30 days ago. Same thing in wheat. Go back to where the bull market started, 06, 07, 08, and just look at what's happened in terms of what we're trading these days in terms of open interest numbers of contracts. Say we averaged 100,000 contracts forever, and all of a sudden we're booming along at 500, 600, 700,000 contracts in open interest. And remember that our industry, farmers, processors, flour millers, really hasn't changed that much. The expansion has been in that outside managed money that has come into our markets and really changed, and I think probably changed for the long term, the structure of these markets and how and why sometimes they do what they do. Same thing, commodity index funds. Remember, the index funds are the ones who are always long. It's just a question to what degree, and as market and prices have slumped, they've certainly reduced their longs, popped up a little bit here in the last several months, but not nearly the size that they were when we really had this bull market roaring. Same thing there, managed money, net positions, open contracts. And again, this clearly shows in the case of wheat, when they were long, went to all-time record short positions in the Chicago wheat market just a couple of months ago. And since then, with this latest price increase in Chicago, they have reduced the size of their positions. The point is that these markets are different structurally than they were 10 or 15 or 20 years ago. We have new players, we have lots of cash, and sometimes their trading minds don't think the same as those of us who have been in the business a long, long time. An old friend of mine who's 85 now, still actively involved, at least to a small extent in grain markets, told me 10 years ago that he and I, with 35, 40 years experience in these markets, were at a severe disadvantage to 25-year-olds with a computer because of all the new programs, the trading systems, the logarithms, and simply the influx of money into our markets that really have no relationship to what you and I do day after day. So, demand I talked about. I don't know which mic I'm using. This mic? Can you hear me okay if I just throw this one away? Perfect. This goes back to the mid-'80s, and this is world wheat production and consumption. The red lines, or the orange lines being world production, the blue lines being consumption, and the red line again is what I consider the start of the bull market. And there's a couple of things you should take from this. First of all, the world has had, as we know, back-to-back record world wheat crops, and not by a small margin, by a big, big margin, by 50, 55, 60 million tons. And we're going to consume not all of that. We're going to build stocks slightly, but we're going to consume a fair portion of that. World wheat consumption, and you'll see the same with corn and soybeans going forward, certainly has not slowed at all since this bull market started. So we used to say high prices is the best cure for high prices, right? As these prices boom to $7, $8, $9, $10 wheat, $400, $500 wheat will curb demand. Really didn't happen. Didn't happen at all. We backed off a little bit in that one time frame, but that was because of some crop shortages in the Black Sea region. And we had pretty good corn crops at the time. World wheat ending stocks, again, stocks to use ratio, the red line, back 06, 07, that's when it was the smallest really had it ever been in modern times when we set new contract highs in the wheat contract. And we followed that with back-to-back record, or big crops, particularly in the Black Sea region, built ending stocks. And then until the last couple of years with record world production, we have started to slowly increase that stocks to use ratio, but certainly not super bearish relative to where we were before the start of the bull market. World corn, similar. Here at the start of the bull market, 06, 07. Red, orange bars, world production, record crops the last couple of years, and the blue line is consumption. My point is we haven't killed demand with record high prices of corn. There are periods of time, particularly here, where we had to ration it, and I don't think that consumption of corn backed off because of corn at $300 or $350 a metric ton. I think it's because we didn't have the corn on hand in the world. So our savior has been that for the last couple of years, both corn and wheat and also soybeans, we have just produced awesome crops. Awesome crops, and it's been able to suck up that increasing demand. Same thing, corn ending stocks to use ratio, world. Here's at the start of the bull market, 06, 07, and certainly the last several years, again because of record production, we are slowly building world corn supplies. Again, in my estimation, not because of certainly not because of decreases in demand, it's been good crops. Same thing in soybeans. Here's the bull market started, $14, $15, $16, $17 per bushel soybeans. Really hasn't slowed demand at all. It's brought us a lot more acres, particularly in South America. It's brought us record crops this year in the U.S., and if their weather holds good for the next 3 months, we'll see another record crop in South America as well. But we haven't hurt demand, And here we sit because of the giant crops. Despite great demand, we've got world soybean supplies at an all-time record high level in terms of stocks-to-use ratio. So from a very, very fundamental standpoint, in my opinion, corn and wheat ending supplies, not bearish. I mean, maybe we've already priced in record world crops. We'll see what weather does. If, from a fundamental perspective, there's a bearish situation out there, at least in the short term, it really has to be in the oilseeds complex, and yet the market hasn't quite reflected that. The other point I'd like to talk about briefly is that high prices, and in some cases record high prices for world crops, have brought huge investments to U.S. and world agriculture. The introduction of very high-tech ag, and I'll talk about that in a minute. Ongoing research in biotech crops. Big increases in crop inputs to enhance yields, expensive seed, and more intensive use of fertilizers and fungicides. All of that has helped us produce these record back-to-back world crops. It's also brought us soaring land values, and it's brought, in some cases, more land back into production. When prices are awfully, awfully strong, and yields have been good, and returns, particularly to farmers in the U.S. and the rest of the world, have been very, 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 very good, farmers are going to spend that money. They want more land. They're going to do everything they can to enhance yields. At $6 and $7 per bushel corn or $300 per metric ton corn, they're not going to hesitate to use all the fertilizer, chemicals, the best seed they can to make sure the yields are there to take advantage of high prices, and that's exactly what they've done. The use of high-tech ag, particularly in the U.S., but it's expanded a little bit more slowly to the rest of the world, has really taken off. And by that I mean precision farming, variable rate fertility. Farmers in the U.S. now plot their land with GPS systems, and then they match that grid to the amount of fertilizer applied, the chemical applied, the yield in those particular spots on their farms. And then going forward, they come back, and when they apply fertilizer, chemicals, seed ratios and rates, they variably apply all those things as well. Point is, they get the maximum productivity out of every acre or hectare that they farm. And that has been the topic of almost every farm meeting in the United States, and I should say all of North America over the last year and a half, is high-tech precision agriculture. The use of drones. I would bet today that probably 50% of the farmers in the area where I am, the north central plains of the U.S., which used to be almost exclusively wheat and barley country, which is now almost exclusively, particularly on the eastern side, corn and soybean country, farmers are using drones to monitor their crops during the growing season. Simple drones that are smaller than that table, that have cameras on them that they launch with a giant rubber band, review the pictures that it's taken, decide which sectors of that field need herbicide applications or insecticide applications or maybe fungicides or whatever the case may be. What they're doing, of course, is seeking to identify yield risk and cost-efficient ways to mitigate those risks within each field. High-tech farming. It's not cheap. Biotech crops, of course, we're familiar with that, although, as we all know, wheat is certainly not on the list. I want to mention just sugar beets, for example. The area that I'm in is a significant sugar beet growing region. North American farmers love high-tech seeds and biotech and GMO and all that sort of things. And to give you just kind of a quick example of to the extent that they embrace biotech crops, probably 5 or 6 years ago, the first GMO sugar beet variety was introduced. And in that very first year, in the Red River Valley, which is the border between North Dakota and Minnesota, like 98% of the crop was planted with biotech sugar beet seeds. And the only reason it wasn't 100% that year is because there wasn't the seed available for that last 2%. The following year, it was 100%. So farmers have been exceptionally quick to embrace biotech crops. And certainly the difference that it's made in our part of the world, the northern half of the U.S. and as expanding into the southern half of Canada, is that it has pushed wheat further out of the equation, and it's made us become part of the Corn Belt. because we have much better short season varieties of both corn and soybeans that they've adapted to our region. As I mentioned, corn in North Dakota has gotten big, soybeans have gotten huge, and that same thing is starting to happen in southern and southwestern Canada as well. I mean, there are some seed companies who estimate that before long they'll have 4 to 5 million hectares of corn in Canada alone within the next 10 years. So we cannot ignore the adoption of the biotech, and certainly the fact that crop prices have been high and returns per acre have been strong has encouraged farmers to embrace that technology. But it is expensive, and we'll talk about that more in just a bit. So one of the key questions to me going forward when we want to know if the bull market is dead, and we look at what's going on with world supply and demand and consumption, and particularly the fact that demand continues to increase, or did continue to increase almost regardless of where prices have been, is will low prices allow this big investment in agriculture to continue? Here's the latest projections, just the 25th of November, of what's going to happen to U.S. net farm income over the next 12 months. Now remember, we've had several years of all-time record high net farm income in the U.S. and really in many parts of the world as well. With certainly the rapid decline in prices, they have trimmed that back pretty significantly. Still looks awfully good relative to where we've been, until you look at what's gone with expenses. Inflation-adjusted expenses have just continued to climb, and even though prices are going to be lower in the next 12 months, at least as of today, their expenses have still gone straight up. Farmland, adjusted value of farmland. In my part of the world, we have seen prices per acre or per hectare almost quadruple in the last 5 or 6 years. It's an incredible change in what's gone on. And have those values collapsed since prices have collapsed? No, they've barely moved yet. I think it's going to happen. They have to soften some, probably not collapse. But the point is that even though net farm income has been very, very strong, as prices drop off, it looks to me, and according to the USDA and others, like their expenses are going to continue to increase. So here's the same came out of USDA in the Commodity Research Bureau. There was the peak. Corn returns per acre over $225 net returns per acre. Multiply that times 2.5 to get the net returns per hectare back just a couple of years ago. Their latest forecast said that in 2014-15, the crop they're going to plant next spring, they're estimating that farmers will lose $100 an acre, or almost $250 per hectare, for every acre of corn they plant in 2015. That's how significantly the balance sheets, the crop budget worksheets have changed on the farms in the U.S. Up until this most recent rally in corn, beans, and wheat, returns had dropped another $80 per acre since this first chart was put together back on August 6th. Now, it's not quite that bad today with a little bit of a pop, but still, as farmers in the U.S. and North America, and I suspect the rest of the world, even though I understand that the super strong dollar has worked to the benefit of production agriculture in a lot of the rest of the world, it's not going to offset, I don't think, completely the drop in prices. Soybean returns per acre, similar, only not to the extent. Corn is by far and away the most expensive crop to plant. Still $25 to $35, $40 losses per acre predicted looking forward, despite the fact that the soybean market has really been pretty strong. And I don't have a separate chart for wheat, but wheat and soybeans are almost identical in terms of costs per acre to produce. In fact, if anything, wheat is a little bit higher price than soybeans because you need the additional fertilizer with wheat. So the point is, going forward, as certainly a farmer in North America, there are going to be some changes, I think, coming ahead in terms of what gets planted, and certainly to the extent that farm inputs or crop inputs are applied to these crops. It's a far different thing for a farmer to use all the fertilizer to the maximum recommendations and seeds per acre and the expensive high-tech seed for corn when you're making $200 or $300 an acre as opposed to when you're losing $100 per acre. And some people will argue the U.S. farmer, for example, is going to plant corn regardless. Going to plant it because he likes it, big yield potential. I'm not so sure that's going to happen in 2015 because I think for the first time in 6 or 8 years, bankers in the U.S. and Canada as well are going to have a much, much stronger say in what farmers plant and what type and the extent of inputs they put on those crops. For example, we think that in our part of the world it costs between $400 and $450 an acre to plant corn, probably $150 to $175 an acre roughly to plant wheat or soybeans. And I think even following 5 or 6 years of record net farm income, I think this year bankers are going to tell a lot of clients, look, I'm not going to give you $400 or $500 an acre to plant corn based on this kind of a scenario. I'm going to risk $150 or $200 an acre for your crop inputs. Why have things changed so much and why should cash be an issue? Certainly farmers in the U.S. have spent money like water in these big yield years and great returns per acre. Over-mechanized, quadrupled the price of farmland in some areas, as I suggested. And there's got to be a period of adjustments that is going to take some time. But remember, it's going to be difficult, I think, to see the same level of crop inputs that we've seen recently based on what's going on with prices. So net farm returns are now negative around many places on earth. And again, I recognize that the very steep rise in the dollar and the decline in other currencies against the dollar, because most crops are priced in dollars, has helped some farmers. But in North America, certainly not. Corn shows the greatest losses. Corn is the most expensive crop to produce. That's why I think we'll see a fairly significant shift away from corn to other crops, which might benefit wheat acreage. But I think in our part of the world, it's going to be like a smorgasbord of crops in the next year. People are going to try barley, they're going to try wheat, they're going to try sunflowers, canola, and back off of some of the most expensive crops. I think that it means that in some parts of the world, marginal acres are going to start to go back out of production. It strictly becomes a dollars and cents game. I think we'll see double-cropped acres decline. In other words, they would plant winter wheat in the midsection of the country last fall, harvest that crop, and throw soybeans on it again next spring. If the crop budget worksheets don't say that that's profitable, I don't think it's going to happen to the extent that it has. If we use fewer inputs, take a few acres out of production, and of course weather is the all-important equalizer, it says to me that we're going to start to see perhaps world production back off of these record levels. And if world production backs off a little bit and we continue to see the demand trend higher, particularly at lower prices, I think it suggests we could see world balance sheets start to tighten. So kind of to wrap it up in a few slides here, strong demand. World demand, world consumption has not been really deterred at all by high prices. We have intense competition, particularly regionally and internationally. And by that I mean, in years, for example, with wheat, like the last couple of, where the Black Sea region, we're going to get a lot more conversation about that later today. When Black Sea regions have big wheat crops, they're going to sell it. They're going to sell it relatively cheaply. And it's going to depress world wheat prices. On the other hand, when we have some issues where that production isn't quite as high, or because of political reasons or such that's prompted the talk now about maybe some sort of a restriction in Russian wheat exports, then all of a sudden we're back to where do we go to get the wheat. Technology, I think, is critical. It comes in a lot of different forms. Genetically modified crops, germplasm, machinery, precision agriculture, and I think to keep pace with what I think is going to be the continued increase in world demand, we need to use all of those things to help us enhance yields. And I think that means prices have to be sufficient to provide incentives to keep farmers doing whatever they can to increase yields. Prices are going to stay volatile. We thought maybe we'd lose that volatility, and I think Dan will probably address that more in his presentation, and yet it hasn't really happened. Can you take me to the next slide forward? Is there Slide's not advancing. Here we go. So here's what I mean about when we talk about funds, when we talk about things happening to markets that we don't think should happen, and how we thought the volatility was going away. Here's a quick look at, this is November soybeans taken 2 or 3 weeks ago. And here's where we were in the steep downtrend to almost right at $9 back in early November. And at that point in time, many of us thought we would see that price drop probably down to $8.50 a bushel, maybe even below that. We were right in the midst of a record U.S. soybean harvest, which pictured U.S. ending supplies increasing 5-fold by next summer. And at the same time, remember the chart I showed about world soybean supply and demand numbers, we're going to have ending stocks at all-time record levels. But in large part, because of ongoing demand to China for beans, which continues today, another big week in U.S. export sales, and because of that demand category called outside money or funds that decided we were cheap enough and mounted a pretty massive buying campaign in soybeans, we changed that price from $9 a bushel, went up all the way to $10.80 some, right in the middle of what should have been the most bearish period of time for prices that we've seen in several years. We marked back the market all the way back off in the last couple of weeks, and then yesterday we had soybeans take another big leap forward, 20, 25, 30 cents. So my point is, there are two sections of this market that you have to keep in mind. There's a fundamental sector that we all look at and say, why would soybeans go back to $10 or $11 when we're going to quintuple U.S. supplies? Well, like somebody told me this past week that reminded me that we'd told clients to get rid of soybeans at this level. Just remember, markets can do anything. This is a headline back from September on the CNBC website, Fear of Global Drought, Get Used to It. And all it did was kind of highlight the need for big crops worldwide and the fact that looking ahead probably could be some problems that are going to be important to world agricultural production. So if you want to read the full article, I think if you just Google global drought, CNBC back in September, that will probably show up. So is the bull market really dead? I don't think it is. I'm not so sure that we're going to see the kind of bull market we had 2 or 3 or 4 years ago, but I just don't think we're going to press these markets to the levels that some people thought we could have 3 or 4 or 5 or 6 months ago. The bull market is dead, in my estimation, only if world weather is absolutely perfect and crop production stays at record levels. And I think we're seeing some signs today that we're going to not have that in 2015. Some people, as you know, are already starting to kind of rework their wheat production numbers for the world. Instead of a 715 to 720 million ton crop in 2015, my guess today is probably we're looking at in the neighborhood of 690, 695 million metric tons because of some different problems around the world and what may or may not happen to acres. And I think when we go back to the period of low prices, it's going to be difficult to sustain record world crop productions if we press world prices down to levels much below where we are today and hold them there for an extended period of time. I think you see crop inputs start to back off from a farmer's perspective. I think you see some land start to come out of production. And as I said, the train of consumption in the world just doesn't seem to want to slow very much. So with that, I'll look forward to questions after the presentations and a good full day session about talking about all these markets and what may happen going forward.
Thank you, Mike. Appreciate it. Absolutely fabulous.